Good morning, good afternoon, or good evening. Welcome to class. I'm going to be your insurance instructor. My name is Scott Schultz, and I work with test teachers, insurance and securities training. And you are here for your insurance licensing exam. We are going to be covering here in this first few videos what's referred to as general insurance. So in the PDF document that you printed out, this is going to be the first section that you'll be able to print out there. Make sure you have it printed out because you're going to want to take some notes as we go along here. Now, if you're going to be preparing for a number of different exams on the insurance side, possibly life and health, property and casualty, so this section, general insurance, is going to be the same regardless of the exam that you're going to be taking. This part of the material is actually on every insurance exam in every state that the exam is administered. So this is kind of where we get a good basis, introduction to insurance, what it is, how it works, some different definitions. We learn a lot about different types of insurance companies in this section and also different ways you could work as an insurance agent or producer. So we will get started right off ahead here, and also keep in mind as you go throughout this course, right at the top of the web page there's a little link that says contact us. You can click that if you have any questions about anything within the material. That email will come directly through to me. I will get back to you as response as soon as I can. Keep in mind though, I'm an instructor, so I teach these classes on a daily basis and possibly could be in class. But I check those emails even when I'm on breaks at class, so I do my best to try and get back to you as soon as possible. Okay, you ready to go? Here we go. We'll start out with a couple definitions. So we have 3 definitions we'll start off with right off the bat. And on this exam, definitions are very important. All right, so we have our first 3, and these first 3 here are basically different entities. All right, so we have number 1 is the insured, number 2 is the insurer, and number 3 is the producer, also known as agent. Okay, so we have the 3 basic definitions here. You've got to know these for your exam. Definitions are very important. It's almost like learning a new language. So this is the language of insurance. You've got to know these things to pass your exam. Okay, so we start with number 1 here, insured. This is the person that's covered by the insurance. So think of it this way. If you have auto insurance, which hopefully everybody does, because in most states it's a law, right, that you have to have liability insurance. Okay, well, you have auto insurance. We need to know who's covered, right, by the policy. Who's covered to drive the car? The person that's covered, or the people that are covered to drive the car, family members usually included, they're the insureds under the policy. So that's our first definition. So we'll put right up here the person covered. Second one, insurer. This is the insurance company. Now, keep in mind here, 1 letter difference between the 2 words. So that's why I circled the D in insured. An insurer, this is the insurance company. Okay, so I mentioned maybe you have auto insurance. Well, whatever company you have your auto insurance through, they're your insurer. Now be very careful on the exam because they like to ask questions about either entity, the insured or the insurer. And there's only 1 letter difference. So a lot of times you might just skip over and not see that last letter. Well, guess what? Depending upon the question, both answers usually are going to be there. They'll do whatever they can on these exams to try and trick you. So you got to make sure that you slow down and read the question. Very important. Now we have our last definition here, producer, also known as agent. Now I want to point this out right here so we can get this straight off. There are a lot of synonyms on these insurance exams. Different words that mean the same thing. Now here we have right off the bat, producer or agent. It means the same thing. Who is this? Well, guess what? This is going to be you. When you get your license, depending on your state, they will either refer to you as a resident insurance producer or a resident insurance agent. In the real world, you talk about somebody who sells insurance, you call them an insurance agent. However, a lot of states, the legal definition is now changing to producer. It means the same thing. This is you guys. So first test question. Most questions ask this. As a licensed insurance agent or producer, who do you represent? Your client or the insurance company? Now the answer you're going to want to pick on the exam is the insurance company or insurer. Who do you get paid by? The insurance company. You get paid a commission. Who do you have a contract with? The insurance company. Okay? So very important you understand that. So we start off with those 3 intro definitions. Then we kind of start to get into some things that are really in that, starting off in that book on that first page, page number 1. Some more definitions. Okay, general insurance here. And by the way, if you've already done your life and health or you've already done your P&C, there's not going to be anything new in these videos on general insurance. So you can go ahead and skip to the next section in the book if you'd like to. However, if you want to, for a review, watch this video again, feel free to do so. Okay, so we've got here insurance, which is very important. This is why everybody's here, right? To sell insurance. Well, you got to know what insurance is. Okay, here's the basic definition of insurance. Insurance is defined as protection against a financial loss. So that's the basic definition of insurance. Why do people buy insurance? Because they want protection. Now here's the key though. What really causes people to buy insurance? We know everybody needs insurance, right? At least as an agent, that's what everybody needs insurance. That's why we're getting into the business. Well, what causes people to buy the insurance though? Here's what really causes them to buy it. Risk. Now a lot of times they ask basic definition questions on the exam about the definition of risk. The definition of risk is the chance of loss. So we said insurance basically is defined as protection against a financial loss. Well, the reason people buy insurance is because risk is present. The chance of loss or uncertainty of loss. Now, beyond this definition of risk, there are 2 subcategories of risk that you need to know for your exam. And the first one we'll call pure risk. Now, pure risk is a type of risk that we have where there is a chance of loss only. No chance for gain. Now, we make a big point of this because pure risk is insurable. Pure risk is insurable. So this is very important for your exam. What types of risks are insurable? Pure risks. Let me give you an example of a pure risk. Example of pure risk would be getting sick. Okay, I get cancer. And obviously I wasn't planning that I was going to get cancer. This is an unforeseen thing. So I get cancer, I'm going to need to have treatments. And it's going to be expensive to get those treatments. Pure risk. Pure risks are a type of risk where there's no potential for gain. What do I have to gain from getting cancer? Nothing. Another example of pure risk. My house burns down. Okay, what's there to gain from that? Lightning strikes my house, burns down. Nothing. This is why I buy insurance, to cover the financial loss that will occur. Now, I said there's 2 subcategories of risk. So we have pure risk, then we have what's called speculative risk. And this is a special type of risk where there is a chance for gain and also a potential for loss, both in the same risk situation. So here, not insurable. This is not insurable. You can't buy insurance for speculative risks. Well, what's an example of a speculative risk? Gambling, buying lottery tickets. Hey, I know lots of states that have the multi-state Powerball or similar lottery programs. So I buy a lottery ticket. Actually, in fact, I bought one last night. So the Powerball right now is at $100 million. I could win. Spent $5. I could lose my $5. What type of risk is that? Speculative risk. Speculative risks are not insurable. If they were, think about it. You go to Las Vegas. Okay, you're at the blackjack table and you put down $1,000 on a hand of blackjack. Is there an insurance agent there saying, hey, you want to buy some insurance for that? It's kind of risky, right? No, they're not. Why? Because there's a potential for gain. They don't want to insure risks that have potentials for gain. They only want to insure pure risks, risks that only have a potential for loss, no chance for gain. Okay, so those are some basic definitions. Some other basic definitions which you're probably already aware of. Premium. Premium is what everybody has to pay for their protection that's provided. So whether it's for auto insurance, health insurance, any type of insurance, that's what you pay to the insurance company. Something that is also probably familiar with is an insurance policy, the word policy. That's actually the legal contract between the insurance company and the insured. So it's legally enforceable. So we'll talk about some legal issues related to contracts later in this section because they're important. It's a legally enforceable contract, so we need to know what causes it to be legally enforceable. So we'll take a look in your book here. This is actually on page 1 in the general insurance section. We'll go through here. I'll tell you some things that you'll want to highlight and make sure when you go back and review to study, make sure you know them for your exam. Okay, on page 1, we have that first paragraph. Now in that first paragraph, the first sentence, highlight, put a star by that, that's the legal definition of insurance. So it says, insurance is a social device for spreading the chance of financial loss among a large number of people. Okay, very important there. Next paragraph, put a star by the definition of insurer. And in the third paragraph down, highlight the first sentence. We said the policy is the legal agreement between the insurance company and the insured. And also in that paragraph, put a star by loss and claim. Loss, they define as a reduction in the value of an asset. In order to be paid for a loss, you have to submit a claim to the insurance company. These are all terms you're probably already familiar with anyway. The fourth paragraph down. Okay, here's where we start seeing some test questions. Risk, highlight, put a star by that. Probably a test question on that. Uncertainty of loss or chance a loss will occur. Reason people buy insurance. Next paragraph below that. Speculative risk. Test question. Is speculative risk insurable? No. Or maybe they'd word it like this. Which of the following types of risks are not insurable? The answer being a speculative risk. We have the next paragraph. Pure risk. Type of risk that insurers are willing to accept. Chance of loss only, no chance for gain. Okay, so a lot of definitions there. We go a little bit further down on the page, bottom of page 1, elements of insurable risk. And we have the last paragraph on the page says, there are 4 ways to manage risk. Now right above that paragraph, last paragraph on the page, I want you to write this. Write risk management. Now this, what we're getting into here, is referred to as risk management. And let's say we define our risk, and we'll say that our risk is we're worried about being involved in a car accident. Okay, that's our pure risk. Being involved in a car accident, having it be our fault. We're financially or legally responsible for those financial damages. So how can we manage this risk? It's present. We want to manage it. We've got 4 options of how we can do this. As stated in the last paragraph on the page, second sentence. Here's our 4 options. Our risk may be, number 1, retained. Avoided, number 2, reduced, number 3, or transferred, number 4. So let's take a look at these in the order presented there. Number 1, we can retain our risk. Okay, so how do we retain our risk? Say we want to fully retain our risk. Do we buy insurance? The answer is no. If we want to 100% retain our risk, we don't buy insurance. We self-insure. Take on the risk 100% ourselves. So we want to retain the risk. We can self-insure. Now, another way to retain the risk, if we buy insurance, is called the deductible. So the deductible is a portion of the risk we retain, even if we buy insurance. So we'll talk about the deductible a little bit later on when we get into property policies, auto policies, homeowners dwelling, commercial property, health insurance. Okay, health insurance policies. A lot of them incorporate deductibles. Okay, so we'll talk more about deductibles later on when we get to that. So we had retain. Well, that's not so fun. So let's take a look what other option we have. Well, we could avoid the risk. How could we avoid this risk? Remember, our risk we're worried about is being involved in a car accident. How could we avoid that? How about this? Sell our car or not drive. Okay, so I get rid of the car and I decide I'm going to drive my Razor scooter to work. Okay, it's great. Well, that's avoiding the risk. Well, that's really not that fun, so let's try this. Let's try to reduce the risk. How could we reduce this risk? Well, how about we take a defensive driving class? Or we could not drive during high traffic times, like during rush hour, maybe stay off the freeway. Okay, those are things we can do to reduce the risk. And we have number 4, we can transfer the risk. And we can do this in one of 2 ways. Number 1 way is through the purchase of insurance. And number 2 is to sue. Okay, so this is going to be of major importance, obviously, because this is why we're all here. When you purchase insurance, you are transferring, right here, you're transferring your risk to the insurance company in return for the premium you pay. Now, there is another way to transfer the risk, however, and that is you can sue. If somebody's negligent, and negligence is defined as a failure to act as a reasonable person would. If somebody's negligent and they damage your property or they injure you, bodily injury they call it, they are legally responsible for those damages. So you have the right, if somebody's negligent, you can sue them to recover those damages. Okay, so these are the 4 ways to manage risk. You probably have 1 test question, if not 2, on these definitions here. And they go on the next page in the book, on page 2. As you'll see there, it says, second paragraph on page 2, a risk may be transferred in 2 ways, as we said, A and B there on the board. If someone's negligence causes an injury, person injured could sue, transferring the burden of risk to the negligent party. Third paragraph down says, second method for transferring risk is accomplished through the use of insurance. There we go. This is why we're here and of major importance for the exam. So we go a little bit further on page 2 to the next heading called Law of Large Numbers. Now, this is another concept a lot of times they ask questions about on the exam. Maybe 1 or 2 test questions. So we really need to have a pretty good understanding of this as well. Now, really, here's how this works. It's a statistical phenomenon, you could say. And the law of large numbers states the more similar risks the insurance companies group together, the better their statistical data will be. So the easier it will become for them to determine approximately how many losses they will have in a given time period. So the more numbers we have, by nature, the better our statistics will be. However, remember, the insurance company can never predict individually who will have a loss. And we're just taking a guess here. But the insurance company needs to be able to take a guess and figure these things so they can determine how much in premium they need to charge. Okay, so let's give an example to kind of help us understand here. Okay, so we have insurance company A, who has 1,000 life insurance policyholders out there. We have insurance company B, who has 10 million life insurance policyholders out there. So A has 1,000, B has 10 million. Which one of the 2 will have better statistical data based on the law of large numbers? A or B? The answer to this is B. Based on the sheer number. They have a lot more numbers to work with. Their statistical data will be much better. Well, let me reword this, though. Which one of the companies will have more losses during a given time period? A or B? The answer is B. Why? Look at how many people they're insuring. 10 million versus 1,000. So which company is going to have less losses? A, because they have so many fewer people insured. However, which one will have better statistical data? Answer, company B, based on the law of large numbers. Okay? So sometimes they try and trick you on the exam, make you think that because we're insuring more people, we're going to have fewer losses. That's not true. We're going to have better statistical data, but we're going to have more losses based on the sheer number of people we're insuring. And we cannot predict individually who will have a loss. Okay, so under the heading there, highlighter, put a star by the second and third sentences in there. Essentially just covering what we did there on the board. We go to the bottom of the page on page 2, insurable interest. This is very important as well, as is most everything in the book here. But a little general explanation on insurable interest. Here's how insurable interest works. Insurable interest is something that was created by insurance companies to help prevent people from profiting from insurance. Insurance is not for profit. Remember, we said we purchase insurance to cover financial loss. Okay, so it's not for profit. So insurable interest states, in order to purchase life insurance, you have to have an interest in the person's life being insured. And for property insurance, you have to have some type of financial interest in the property being insured. So example, in life insurance, you have to have insurable interest at time of application. So write that down, very important. Those of you doing property and casualty, for property and casualty insurance, you have to prove insurable interest 2 times. Time of application, time of loss. So it depends on which exam you're taking. If you're taking the life and health or the life only exam, you have to prove insurable interest at time of application and never again. For property and casualty insurance, you have to prove insurable interest at time of application, number 1, and at time of loss. Very important. So in property and casualty insurance, if you don't have insurable interest in the property, you can't insure it. And if you have a loss, if you don't have insurable interest in the property, you can't collect on the claim. So in life insurance, here's kind of how it works. Okay, we'll say that, you know, on my weekends, I like to go down to the hospital here in town, and I go hang out by the emergency room. And what I do is I kind of lurk around where the ambulance unloads there, and as people are getting wheeled into the ER, I kind of take a look at their chart and see what the prognosis is and the likely outcome if they're going to make it out of there alive. And the people that aren't, I call up my insurance agent and say, hey, you know, I've got John Smith here, and I want to buy $5 million of term life insurance on his life. Can I do that? No. Why though? Insurable interest prevents me from doing that. Cannot profit from insurance. So in life insurance, who do I have insurable interest in? Immediate family, so relation by birth, mother, husband and wife, mother and father on child, child on a parent if they're being supported by them. Who else? Business reasons. Partners can purchase life insurance on each other. Businesses can purchase life insurance on key employees. Now keep in mind though, you have to have the person's consent. Because if we're going to be buying life insurance on someone else's life, who has to sign the application? 3 parties. The applicant, which would be the owner, the insured, which would be whoever the insurance policy's life is written on, and the third party being the agent or producer. Okay? So those 3 parties have to sign. The only situation where you wouldn't need consent, obviously, would be a parent on a child because they're a minor, they couldn't give consent anyway. So that would probably be the only situation you wouldn't need consent to purchase life insurance on a person. Okay, so bottom of page 2, we have second paragraph from the bottom. Just mentions insurance is not for profit and also states their requirements called insurable interest. Now we go on to page 3, top of the page. First paragraph, put a star by that. There's the answer to the questions most likely on the exam. For life insurance, insurable interest must exist at the time of application, but it need not exist at the time of the insured's death. For property and casualty insurance, insurable interest must exist at the time of loss. Okay, so very important stuff there. Now we get to that next heading, insurable risks. And we have a bunch of paragraphs here in the bottom of page 3. We'll kind of briefly go through them. You might see a question on any of these things, but pretty basic stuff. First one we have is large number of homogeneous units. Homogeneous here meaning similar. What the insurance companies are trying to do is group together similar risk exposures. Kind of relates back to law of large numbers that we talked about. Next paragraph, loss must be ascertainable. What does that mean? Well, in order for a risk to be insurable, we have to be able to put a dollar value on the risk. So, life insurance. Okay, we buy life insurance, they put a dollar value right in the policy. We die, that's what they pay out. So they're putting a dollar value on our life. Auto insurance. We get in a car accident. States in the policy exactly what they will pay up to what limit. Okay? So we have to be able to put a dollar value in the policy. Next paragraph, loss must be uncertain. Obviously, the insurance companies don't want to cover certain losses. In fact, they will add exclusions as much as they can to exclude anything that's a certain loss. Economic hardship, the loss must cause an economic hardship, pretty straightforward there. Last paragraph, exclusion of catastrophic perils. Okay, some good information in this paragraph. First thing is the definition of peril. Peril is defined as a cause of loss. This is very important in the property and casualty exams because you learn a lot about perils in the various policy forms, and also in the life and health insurance exam. Now, we talk about life insurance. There's only one covered peril. What do you think that would be? Death, right? Peril is the cause of loss. What's the cause of loss that's covered in life insurance? Death, that's it. Okay, so really it should be called death insurance. Kind of make it hard to sell, I guess, if you called it that. So life insurance, much better name, right? Now, the last paragraph says catastrophic perils. Catastrophic perils. What are these? Catastrophic perils are perils that are so high risk, no insurance company can take them on, because if they did, they would have the potential risk to go bankrupt if they had a claim. So here we're talking about floods, nuclear risks, war, terrorism. Okay, these are catastrophic perils. And exclusions are things added in policies taking coverage away and have the effect of clarifying coverage, really. So we go on to the next page on page 4. Top of the page we have principle of indemnity. Okay, so this is a concept that you definitely have to know for your exam. Very important. So we'll take a look up here on the board real quick and see how this works. Now, this principle of indemnity states you can't profit from your insurance. So we're kind of seeing a running theme here, right? I've said this about 10 times already. just in the first few minutes here of class, you can't profit from insurance. Well, people are going to try to profit off insurance. All right? So what do the insurance companies do? What can they do to protect themselves? They create these things that they add to the policy. Provisions, such as principle of indemnity. States can't profit from your insurance. How does it do this? Well, it says right in your policy will pay your loss or the policy limit, whichever of these two is less. Okay, so that's one thing they're going to do. Now, principle of indemnity also, sometimes they say, states that your insurance will make you whole again after a loss. What does that mean? We're talking about your financial structure. So think of this right here as you financially as a whole. Well, what happens if you get sick and you have to go to the hospital? We'll say you get valley fever. Okay, I had a guy I knew that got valley fever, and he ended up in the hospital for 3 months. Young guy, he was like 32 years old. Got valley fever, ended up in the hospital, 3 months, and he almost died from it. I have no idea what his hospital bills were, but, I mean, geez, 3 months in the hospital, you could be talking about $70,000 for 3 months in the hospital, surgeries, doctor's visits, all that stuff. It adds up. Okay, so now obviously he wasn't planning to get valley fever. So he has health insurance. This is what provides protection for his financial loss. Pure risk. Well, this is going to take a huge chunk out of his financial structure, because if he didn't have insurance, who had to pay for that? He did. Now, this is why we buy insurance, okay? To fill in this loss that we would have to pay ourselves had we not had insurance. So, principle of indemnity says our insurance is there to make us whole again. Our financial structure, to fill in that big hole that this loss created. Now, keep in mind though, policy will pay loss or the limit, whichever the two is less. So let's assume that he had a health insurance policy, but it only covered this loss up to $50,000. So what's the insurance company going to pay? $70,000 or $50,000? Well, obviously, they're going to pay $50,000 because that's the policy limit, and they'll pay whichever the two is less. Now let me change it around real quick, and we'll say that instead of $50,000 of coverage, say that he had $80,000 of coverage for those services. What's the insurance company going to pay? His loss, $70,000, or $80,000, the policy limit? Obviously, they're going to pay $70,000. Well, you mean they're not going to give him an extra $10,000 because they feel bad that he got valley fever and say, hey, why don't you go to Hawaii on us? No, the insurance company's not going to do that. No way. They're going to pay loss or the policy limit. You can't profit from your insurance. In fact, the insurance company will do anything they can to prevent you from doing this. And this is what the principle of indemnity is. So we'll see this throughout life and health insurance, throughout property and casualty insurance. It's a recurring theme. There's other provisions that reinforce this principle of indemnity. So just keep it in the back of your mind as we go throughout the course here. Okay, top of page 4, highlight the first paragraph. Principle of indemnity restores the insured person in whole or in part to the condition he or she enjoyed prior to the loss. Restoration may take the form of payment, repair, or replacement. And we go on ahead to the next setting, which is insurers. So, question for you. Who's an insurer? Is an insurer the person covered by the insurance, or is the insurer the insurance company? Now, you better know that one. Insurer is the insurance company. Now, as we'll see here in the next few pages, there's a number of different ways insurance companies can be organized. Now, the two most common and most likely questions on the exam are stock and mutual insurers. So we have number 1 and 2 there in the center of page 4. So we'll do a little chart, compare and contrast the differences between a stock and mutual. Now, both of these companies being corporations. So we start with number 1, a stock insurer. First important thing to know with the stock, stockholders. Now, another thing we'll mention here, dividends. Basically what dividends are is a sharing of earnings of the corporation with its owners. Now, dividends are declared by the board of directors of the corporation. So every quarter the board of directors are going to sit down, they're going to talk about a number of things related to this corporation, but they're also in part going to take a look at the earnings of the corporation from the previous quarter. And they'll say, well, we did really well in our earnings. we want to declare a dividend. So board of directors declare a dividend. So dividends, sharing of earnings with the stockholders. So in a stock insurer, dividends are paid to stockholders and are taxable. Okay, so review some of the things there. Stock insurers are owned by stockholders, also referred to as shareholders. Now, if the corporation, if the board of directors declares a dividend, the dividend is paid to the owners of the company, and the stock insurer being the stockholders. Dividends are taxable. So if I'm a policyholder with a stock insurer and I own no stock, I will never receive a dividend. Okay, if they declare a dividend, it gets paid to the stockholders, not the policyholders. So they have a term that they relate to stock insurers. The policy stock insurers issue are referred to as non-participating policies. Because if I buy a policy from a stock insurer, I will not receive a dividend, even if it's declared. Okay, so we take a look at difference between stock, and now we have the mutual. All right, now with the mutual is owned by policyholders. Now, true mutual, which is what they'd ask about on the exam, has no stockholders. All ownership rests with the policyholders. Now, mutual has a board of directors because remember it's a corporation, and dividends, if they're declared, are paid to the policyholders. Now, another thing we'll add in here, dividends are not taxable. Dividends paid by mutual insurers to policyholders are not taxable, and further by the IRS are declared as a return of overpayment of premium. And remember, we pay our premium with after-tax dollars. So if the mutual insurer is going to share some of that back with us, it will not be taxable. Okay, and another thing I'll just mention, I won't write it on the board, but dividends can never be guaranteed. Never. Remember, it's at the discretion of the board of directors. Just because a corporation has good earnings or high earnings does not guarantee they're going to pay a dividend. Okay, so what else do we have to mention here? Well, mutual insurers issue participating policies, or PAR policies. Okay, so we've got participating policies. I own a policy from a mutual. The mutual declares a dividend. It comes to me. I'm participating in the dividends being distributed. Participating policies. Okay, so take a look at the book. Difference between stock and mutual. Highlight those differences that are underlined there. And then we go to 3 nonprofit service organizations. These were the HMOs. This is what the category was created for, the HMOs, nonprofit service organizations. We'll talk much more in detail about those in the health for those of you taking that course. We go to number 4, reciprocal insurers. Reciprocal insurers. Now, you might have a test question on these guys. Couple differences. Okay, number 1, unincorporated. Reciprocals are unincorporated. Probably one of the biggest we have here in the States is called USAA. The insurance company USAA. They are a reciprocal insurer. So we have some terms that are a little bit different. Now, the word reciprocal basically means circular. So here's how it works. If you purchase coverage from a reciprocal insurer, what you buy is referred to as an indemnity agreement, not a policy. So you're purchasing an indemnity agreement. And that indemnity agreement states that you are agreeing to insure other members of the reciprocal. So everybody that purchases coverage from a reciprocal is actually insuring each other in a circular fashion. And there's where that term reciprocal came from. Now, another term you'd see here, subscribers. They don't refer to their policyholders as insureds. They call them subscribers. And the last term that would be of major importance would be attorney-in-fact. The reciprocals have an attorney-in-fact who basically are like a CEO. Okay, so they oversee the whole reciprocal. They make sure it's maintaining profitability, help with underwriting, take care of the day-to-day operations. That's an attorney-in-fact. So you see those things that are underlined there are very important. Maybe one test question there. We go to number 5, fraternal insurers. Now, fraternal insurers, this usually had to do with, as it says there, a lodge or fraternal organization, such as the Knights of Columbus. They're a good example of a fraternal. Fraternals were created to sell insurance only to their members, and they primarily sold life insurance only. Now, one big thing with a fraternal is generally the policies that were sold were assessable policies. So you see that in the last sentence there in that paragraph, so put a star by that. Assessable policies are policies where if the insurance company gets into financial difficulty, they can actually request that their policyholders pay a certain amount of money to help them get out of that financial difficulty. Most all insurance policies are non-assessable. However, most fraternals issued assessable policies.